We're starting to see a lot of people talk about crypto being over, bear market is here. Don't know, let's see what people are doing.
Kevin O'Leary has just announced that he's exited all of his crypto holdings. The Shark Tank investor made one of the boldest moves of his career, liquidating every altcoin, meme token, and speculative play in his portfolio to concentrate entirely on just 2 assets. According to O'Leary, this decision isn't simply about streamlining his investments. It's a deliberate shift to prepare for what he believes could be the most powerful phase of the current crypto cycle. A stage driven by structural market forces that most investors haven't even recognized yet. In this video, we'll unpack why Mr. Wonderful decided to abandon dozens of smaller crypto bets and consolidate into 2 major positions. We'll examine the institutional accumulation that's creating serious supply constraints in both Bitcoin and Ethereum. O'Leary has been increasingly outspoken about his research team's latest findings, and their data on market positioning paints a fascinating picture.
So this information is old. This is a kind of a faceless channel with a face. This is AI actually. This guy here is AI. So this is actually a good business model if you are looking for different ideas to make money. This guy is not he's not real. And you can see it once you really keep looking. This is an AI probably from like a HeyGen, and he's basically pulling up information, put it on YouTube, gets views, he makes money. But the information he's bringing up, Kevin O'Leary has been saying he sold everything. I feel like I sold this like a month ago and just put it into Bitcoin and Ethereum because, again, you can't outtrade these guys. He said this like a month ago before all this crash came because they all know what's about to happen. The richest people in the world set this up. They buy low, it comes up, everybody's buying in, then they sell and they make money, and then you ride the crash down, and then you need money. So you end up having to sell when you should be buying. So this is where like you can't listen to these people. You can only dollar cost average, and that's how they can't affect your wallet. So let me get back to what it was saying.
The institutional accumulation that's creating serious supply constraints in both Bitcoin, and their data on market positioning paints a fascinating picture of what's unfolding right now. Before we begin, a quick reminder, only a small percentage of viewers are actually subscribed. If you're finding value in these breakdowns, take a moment to hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's get into it. Here's Kevin breaking down why he cut his crypto holdings from 27 positions to just 3.
If I want exposure to crypto, I only need 3 positions now. I used to have 27.
This isn't routine portfolio rebalancing, it's a complete change in how one of the world's most recognized investors approaches digital assets. O'Leary's research team spent months studying thousands of tokens, new DeFi projects, and emerging blockchain trends. Their takeaway was simple but bold: none of it was necessary. According to Kevin, there are only 3 positions worth holding: Bitcoin, Ethereum, and a stablecoin. In his view, that combination captures the foundation of
For my stackers, people using Stackit.ai, link in the description. What is Stack made up of? Bitcoin, Ethereum, and USDC. And I came to this conclusion years ago, built a product, and has helped people with over $10 million do what he just said. Him and his large team finally came to the realization that we came to years ago. No, 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 I'm not flaunting or anything, but it's true.
entire crypto economy. Bitcoin as the hard asset, Ethereum as the infrastructure layer, and a stablecoin as the liquidity bridge that connects both worlds.
But if you look at statistically, the volatility of just Bitcoin and Ethereum and a stable coin for liquidity, we pick your stable coin. Some people like Tether, some people like USDC. That's all I need to own.
What makes this strategy remarkable is its simplicity. It cuts through all the noise that usually surrounds crypto discussions. There's no speculation over which layer 1 network might dominate, no hype around meme coins, and no complicated yield.
The problem that happens is people feel like they got left behind by Bitcoin and Ethereum, and they know, oh yeah, Bitcoin was $5 grand and now it's 100, so I missed it. Ethereum was $300, now it's $3,000. I missed it. What you don't see is the yearly compound interest by Einstein's own words is the eighth wonder of the world. That's because if your money just compounds 15% a year, every 5 years you double your money. Bitcoin has been 30, 50, 100%, Ethereum as well, per year on average. You can double your money with Bitcoin and Ethereum, but people don't want to double their money. They want to mostly gamble. They want to say, okay, I'm going to put $200 and I'm going to make 40,000. That is not investing. That's gambling. You might as well put money down in Vegas if that's how you're thinking about investing. An investment is putting money here. I'm not going to touch it for years, 5 years, at least 1 year. That's why they made the tax law. You get less tax if you hold an asset for over a year. But most people don't think like that. They think, oh, I'm going to put this money here. It's going to double in 30 days and that's gambling. That's not investing. And we'll see what ends up happening. But the market is falling right after he sold everything. So I'm sure he had no idea.
Schemes. Instead, it focuses entirely on three assets that represent the core of the crypto ecosystem: Bitcoin, Ethereum, and stablecoins, each reflecting a piece of the industry's lasting value rather than its passing trends.
I want a 2.5% weighting in Bitcoin in any portfolio, and I do a 2.5% weighting in Ethereum. And both have performed very well for me.
The precision behind these allocations reveals everything about O'Leary's mindset. This isn't about speculation or chasing the next explosive rally. It's a carefully structured portfolio built around defined risk limits and clear objectives. What makes it even more intriguing, though, is the yield component that underpins the entire strategy.
The strategic reason I do that, because I can wrap Bitcoin and Ethereum and get yield on my portfolio every month.
What do we do in Stack? We wrap the Bitcoin, bring the Ethereum into Aave, borrow against it to either spend or invest more. It's the same thing. These rich guys are coming to the conclusion I came to, and I didn't come from finance. It's not hard to see once you look at the whole space.
So that's what I do. I'm not telling people what to do, but when I own assets, I want yield, I want distributions, I want something while I'm waiting for price appreciation.
This approach redefines how crypto fits into a portfolio. Instead of treating digital assets as speculative bets, it turns them into income-producing holdings similar to dividend-paying stocks or bonds. By tokenizing Bitcoin through Ethereum-based protocols, O'Leary earns consistent monthly yields while still benefiting from the potential price appreciation of both assets. The reasoning behind O'Leary's focus makes sense once you understand what Bitcoin and Ethereum truly represent in the larger crypto landscape.
When crypto sort of started, there was a whole bunch of meme coins and tokens and securities, 10,000 of them that are out there. But you don't need to own any of those to get exposure to whatever you think the value of crypto is.
What he's emphasizing is the core mistake most new investors make, chasing complexity that adds no real advantage. Thousands of altcoins claim to offer groundbreaking technology or life-changing gains, but
Now, I'm going to tell you, most people who get into this game, they dabble in these coins as well. I treat these coins as gambles. I say, okay, some as investments, some I haven't. I'm like, okay, I think this company is going to be huge one day because I see a lot of people use it. Coins like Aave, not to be not financial advice, not as financial advice, because I see we have had a bunch of assets be put into Aave, and Aave has $60 billion of other people's money as well in there. So I know Aave is a long-term thing. So I say, okay, I'll put money in Aave and I'll wait 5, 10, 15, maybe 20 years and see what happens with that money. Could be wrong. And Aave could go out of business or some other company could come along and beat it. Chainlink is another one where they have a dominant foothold on a specific part of the crypto space. And from what Kevin O'Leary's saying, you could use both of those as collateral. So you could bring in Aave, Chainlink, Bitcoin, Ethereum, borrow off of them, take profits. And you get interest by having them in Aave, because anytime they lend out that coin, you get interest. So there's a bunch of different things that you can do. And the truth is, a lot of people, once they just got Bitcoin, Ethereum, they start looking at others, but that also wrecks most people. They put it in coin that they think is gonna 1000x and they lose all their money. So, I mean, I've seen it many times happen to me. But I think the new way to think about it is Bitcoin, Ethereum is your base, and borrow to do other things, or make sure you take profits and take that profit in and then do other things, stuff like that.
Shows a clear pattern. The vast majority of significant price performance and institutional capital continues to concentrate in just two assets, Bitcoin and Ethereum.
And I'm talking about the price volatility of Bitcoin and the alpha that we give to your portfolio if you believe in Bitcoin. So I've taken a whole new strategy since we last talked about this. I'm focusing on two securities, Bitcoin and Ethereum.
The term alpha, as O'Leary uses it, is key to understanding his reasoning. In investing, alpha refers to the excess return generated beyond what overall market movements can explain. According to his research team, Bitcoin and Ethereum already deliver enough alpha to make holding any other crypto assets unnecessary. In their view, these two alone provide the performance, liquidity, and long-term upside that the rest of the market struggles to match.
And they have less downside risk, right? But again, they have downside risk. Like in the past week or month or whatever it's been, month two, Bitcoin went from 126,000 to today is it was 81 when I woke up. That's a 45. That's like a ridiculous amount. That's like $46,000 drop, right? $45,000 drop in a couple of months. That's a big percent drop. And Ethereum was $4,800, and when I woke up, it was $2,800. So that's almost that's a big amount, right? So yes, it will fall, but this is where what I built and what I do. So as the prices are falling, we're selling. We're selling to protect some of that fall, and then we're buying back in. Because yes, you could just watch the price go up and down. But if you wish you would have been able to, if you go back and you say, man, I held Bitcoin, I bought it at 120, it's at 80 right now. I really wish I would have sold some at 100. It's hard to do that in the moment. It's too emotional to do. So I let AI and automation do it for me. But these guys are quadrillionaires. They do all kind of crazy stuff too. But we, as normal people that just have to live life and can't just look at these charts every day, all day, we need something else to do it for us.
Think about owning crypto. What you're exposed to is price volatility. Sometimes it's good, sometimes it's bad. Sometimes it goes up, sometimes it goes down. But with the advance of a stablecoin act, for the first time we're thinking about, okay, financial services and Wall Street, to put it lightly, they're going to go on chain now.
Kevin's reference here points to the
And when I say I sell Bitcoin and Ethereum, I turn that Bitcoin and Ethereum into stable coins. We use USDC as stack. So we'll turn, let's say the prices are falling, we'll take some of that to protect the loan and protect your profits. We turn it into USDC. It's a stable coin, and then we dollar cost average that stable coin back into Bitcoin and Ethereum at that lower price. That's how the app works, actually.
Coin Act, specifically the Genius Act, which was passed in July 2025. This legislation marks a major turning point in how traditional finance interacts with blockchain technology. It established clear regulations that allow major financial institutions to operate on public blockchains such as Ethereum.
And this is huge because this is going to bring in trillions of dollars into the crypto space. And what are most of those people going to do? They're going to buy Bitcoin and Ethereum. They're going to buy a lot of these other coins too, but they're definitely going to buy Bitcoin and Ethereum too. And that the price is going to appreciate. It's probably not going to appreciate as the random 1,000th coin, but it will appreciate. So you got to be in the game and slowly dollar cost average for as long as possible to take advantage, because none of this stuff has really hit yet.
Without the legal grey areas that once held them back. That clarity has been a key catalyst behind Ethereum's recent surge in value. The Genius Act effectively gave Wall Street permission to start building on Ethereum's rails, opening the door for large-scale integration, tokenized assets, and institutional-grade applications that are now fueling its growth.
You know that because if you want to transact with a stablecoin as a payment system, you need to put it on the blockchain. And which blockchain is getting the majority of that? Ethereum.
The data supports this shift clearly. Ethereum now holds around $165 billion in stablecoins, accounting for roughly 57% of the entire global stablecoin market. Even more strong.
That's why when I talk to people and I'm like, you still don't believe in crypto? This is not Santa Claus. There's billions of dollars doing this already. Like, this is going to happen whether you're in it or not. I just rather you be in it with as much money as you possibly can and still be able to live your life.
Is the recent growth rate. The network has been adding close to $1 billion in stablecoins every day, marking the fastest expansion recorded so far this year.
And so the only two securities that you see highlighted around the world each day, minute by minute, as they get priced, are Bitcoin and Ethereum. And so if you own those two, you're exposed to over 90% of the alpha and volatility of the entire crypto market. So why own anything else? I don't anymore.
The 90% figure isn't an exaggeration. It's based on real market capitalization data and price correlation studies showing that Bitcoin and Ethereum account for nearly all meaningful movement in the crypto market. Kevin's argument is straightforward. If two assets capture about 90% of the upside, owning dozens of smaller positions doesn't add value. Bitcoin and Ethereum already represent the heart of the entire space. Interestingly, O'Leary wasn't always optimistic about Ethereum or crypto in general. Only a few years ago, he was one of its most vocal critics. So what caused the shift? Let's look at the bullish developments that changed his outlook and convinced him to make Ethereum one of the only two crypto assets he continues to hold. The biggest factor behind Kevin O'Leary's new bullish stance on Ethereum is a major shift happening in institutional markets, the rise of Ethereum treasury companies that are rapidly accumulating huge amounts of it.
And this is our next move with Stack. We're helping companies create Bitcoin and Ethereum treasuries. This is what the biggest companies in the world are doing this. Now, anybody can do it. You can do it as an individual. A mom and pop coffee shop can do it. Gas station, flower shop, freelance designer, influencers can all do this with the click of a button. Yes, you got to understand it all, but it's possible. And I believe this is going to be a huge, huge industry. That's why I'm trying to be a part of it.
This development is unlike anything seen before in the crypto space. At the front of this movement is Bitmine Immersion Technologies, the largest corporate holder of Ethereum. Bitmine owns around 3.4 million Ethereum, valued at roughly $13.25 billion. Bitmine isn't the only player. Sharplink Gaming, the second largest Ethereum treasury company, holds about 859,000 Ethereum valued at $3 billion. This rapid institutional accumulation is producing what analysts describe as a supply squeeze. Wintermute, one of the world's largest market makers, recently reported that its over-the-counter Ethereum inventory has been nearly depleted. That scarcity makes Ethereum far more sensitive.
So what that means is they'll do trades and sales behind the scenes that don't affect the market pricing because it's not like being bought on Coinbase. They're almost out of Ethereum to do that with. That means there's not a lot of Ethereum left. Price should go up. But again, this is old information and price came down pretty hard. So this is where I just tell everybody over and over and over, you cannot trade this stuff. You have to just eat the volatility either up or down and keep dollar cost averaging. If you believe in this stuff, if you can do that for years, I don't know how many years. It could be 3, it could be 5, it could be 10, it could be 20, whatever. If you can keep bringing in little bits of money over a long period of time, you will reach your financial goals. Not financial advice, but if you want to check out how Stack works, check out the link in the description. And thank you. Like and subscribe.